Good morning and welcome to Carr and Ingram's year-end tax planning webinar. On this webinar today, we're going to focus on some tax strategies and tax information specific for individuals. So as 2020 winds down, and we all know it's been a crazy year, but taxes are still on our mind as we wind down 2020. So we're going to cover some basic information, some law changes that you may not be familiar with. And then we're also going to cover some kind of tried and true tax planning ideas that you can think about. And if you need more information on, you can reach out to your CRI advisor who can help you out with that. Before we get into the actual presentation, I want to go ahead and go through the CPE certification. If for those needing CPE credit, we do offer CPE credit. To do so, you have to have your own unique GoToWebinar link and be registered and logged in under your own link. You also have to respond to at least 80% of the polling questions. And if you're online for at least 50 minutes and answer the polling questions, we can give you 1 hour of CPE. Certificates will be emailed out within 7 days. And if you don't receive your certificate after 7 days, feel free to email our marketing team who can check into that for you. Also want to point out that if you'd like copies of the slides, you can go to the handouts section of the GoToWebinar platform that has a copy of the slides that you can download during the webinar itself. If afterwards you would like a copy of the slides, everyone who registered will receive a copy of the recording here, as well as a copy of the slides. So you'll be able to get that in your email shortly after we conclude here. Everyone will be on listen-only mode for the duration of the webinar, but we will be tackling as many questions as we can. So if you have any questions that arise during the course of the webinar, feel free to enter those in the questions section of the GoToWebinar platform. Now let me introduce our presenters today. First, let's see if we can get the slides moving. Looks like we got a little lag going in the slides, but I'll go ahead and go through introductions here. My name is Chris Hoffman. I'm a partner in the Nashville, Tennessee practice office. I'm also the tax service line leader of the firm. About me, I live in Nashville, Tennessee. I went to college though. I got my master's degree from the University of Tennessee. I enjoy watching my Volunteers as well as the Tennessee Titans and the Nashville Predators. Every year we do make a pilgrimage to Hilton Head, South Carolina as a family, and I have two furry dogs at home, 2 Boston Terriers. Also presenting today will be David White. He is from our Tallahassee, Florida office, and he got his master's degree from Florida State University. He does enjoy watching all his Seminole sports, as well as spending time outdoors with his family. And he has a 15-year-old lab, and he also fosters kittens. Lastly, we have Jennifer Jenkins. She is a partner in our Laurel, Mississippi office. She has her master's degree from the University of Mississippi. She brings to us more than 20 years in public accounting. She is currently training to run a 10K, and at home she has a miniature straight-haired Labradoodle to keep her company. So the agenda today, we're going to start out with just going through the blocking and tackling, the updates to brackets and deductions. We're going to then go through some of the unique considerations to 2020. That's going to cover some of the tax law changes that have occurred that may be different this year than prior years. We're going to cover itemized deductions, things you can do with year-end planning surrounding itemized deductions, and then also cover retirement accounts. There's also some ideas you may want to consider with capital gains and losses, and then we'll have a general other considerations where we cover a few other topics that don't fit neatly in one of the other categories. We'll then wrap up. If we have any time left, we will take any questions. But as I said before, if you have questions, go ahead and enter those now so we can try and tackle some of them as we go throughout the webinar. And with that, I will now pass it over to David, who will tackle the 2020 updates, the brackets and deduction.
All right, thank you, Chris, for the introductions, and thank you to everyone who's attending this webinar. The first item we're going to touch on is what to expect from the income tax rates and some deductions. So as you can see here, the 2020 tax rates themselves are the same as the rates in effect for the 2019 year. However, as they are every year, the 2020 tax brackets are adjusted to account for inflation. Also, something I want to mention every time we talk about tax brackets, the US tax system is progressive, with lower brackets paying lower rates and higher tax brackets paying higher ones. Unless your income lands you in the lowest tax bracket, you actually are charged effectively tax at multiple rates as your income rises, rather than just at the rate of the bracket into which you fall at the end. The tax bracket range also differs depending on your filing status. So the phrase of jumping into a higher tax bracket just means that your next dollar and subsequent dollar is taxed a little bit higher, which is also known as the marginal tax rate. We see here we have the single and married filing jointly tax brackets, and then we also have the married filing separately and the head of household brackets on the next slide. Moving on from there, we'll review the changes to the standard deduction. Overall, compared to 2019, the amounts for the 2020 deduction generally increased by a few, by a few $100s. Even if you have no other qualifying deductions or tax credits, the IRS lets you take the standard deduction on a no questions asked basis. You can either take the standard deduction or you can itemize on your tax return. You can't do both. Itemized deductions are a more involved topic that Jennifer is actually going to touch on shortly. Now, as you see here in the far right column, something that's different for 2020 is the charitable deduction that you may or may not have heard of yet. As a general rule of thumb, charitable contributions can only be a deduction if you itemize your personal deductions instead of taking the standard deduction. The CARES Act instituted a provision allowing people to deduct $300 for charitable contributions made in 2020. If you're married and filing jointly, your deduction is still limited to $300. It doesn't double, but taxpayers are allowed to take this universal deduction no matter whether they itemize or take the standard. Deductions must be in cash, so cash or cash equivalents, checks, credit card payments, etc. So not non-cash charitable contributions, and they must be given to a 501c3 public charity. As a side note, the universal deduction is something that charities and nonprofits have been really seeking for many years. So while this provision is far from their ideal solution, they'd much prefer it to be an unlimited deduction. The $300 amount and the baby step of adopting the overall concept of a universal deduction compared to having it be an itemized deduction is an interesting next step in that direction. I'd like to also talk about health savings account changes. HSAs, health savings accounts, are a type of savings account that lets you set aside money on a pre-tax basis to pay for qualified medical expenses. For 2020, if you have a high deductible health plan, you can contribute up to $3,550, up $50 from 2019 for self-only coverage, and up to $7,100 for family coverage into an HSA. Now, HSA funds do roll over year to year if you don't spend them, and an HSA may earn interest or other earnings, and they're not taxable so long as you use the HSA funds for qualified medical expenses. So if you're planning to take advantage of this, consider making and maximizing the HSA earlier in the year so the funds in the HSA essentially grow tax-free. Okay, Chris, I think with that, we actually have our first polling question.
Great. Thanks, David. Appreciate it. First polling question covers that above-the-line charitable deduction that David talked about. That new above-the-line charitable deduction is available, and we're launching the polling question now. Is it available when you itemize your deductions? Is it only available if you're elderly or blind? Is it only available if you donate to COVID-19 related charities? Or is none of the above available, or is none of the above applicable, sorry, to the new above the line charitable deduction? So give everyone a few moments to respond here. Again, we have limited time, so we're going to try and move through these polling questions as fast as we can. For those needing CPE credit, you'll need to respond to at least 80% of these polling questions. So go ahead and get those responses in, and we will look at the results now. So it looks like 79% of the above says, 79% of the audience says none of the above. 15% says you only get above the line deduction if you itemize your deductions. 5% say only if you donate to COVID-19 charities. David, I think the majority of people are on board with this new deduction, but can you clarify for folks?
Sure, absolutely, Chris. The 79% are correct. You actually get this deduction if you donate to a 501c3 charity, so it doesn't just have to be a COVID-19 related charity. And if you do so, you can get that deduction regardless of whether you itemize your deductions or you use the standard. So whether you itemize or use the standard, it is something in addition to that.
Okay, thanks.
Sure. All right, thanks. Next.
Go ahead, David. I was just going to introduce you, so go ahead and take it from here.
Sure. Thanks, Chris. We're next going to talk about some items unique to 2020. The first one being under the CARES Act, payments in the amount of $1,200 for single individuals or $2,400 for those married filing jointly were distributed to eligible Americans, plus $500 for each child under the age of 17, also subject to income limitations. Now, these one-time payments are not taxable. They are actually an advanced payment of a credit that will be recomputed on your 2020 tax return. If the recomputed amount is higher than what you received based on changes in either income or qualifying children, you'll actually get an additional credit on your 2020 tax return. Now, if it goes the other way and the amount is lower after it's recomputed, the repayment of the excess amount is not expected at this time. Also, just to reiterate it for regarding that last polling question, the $300 above the line charitable contribution deduction is, in short, you get this if you donate cash or cash equivalents to a qualified 501c3 charitable organization, and you can receive this deduction even if you use the standard deduction. Now, regarding retirement accounts, the CARES Act also allows for a COVID-19 related relief withdrawal of up to $100,000, avoiding the normal 10% early withdrawal penalty. I wanted to mention this as a new item that perhaps some of you have taken advantage of or will before year end, and Jennifer will actually go into more of the specifics regarding this in her discussion on retirement plans. Regarding the payroll tax deferral, if you recall earlier in the year, there was an option that allowed employers to defer the employee portion of Social Security tax from September 1st, 2020 through December 31st, 2020 for eligible employees who earn less than $4,000 biweekly. To repay the deferred amount of the employee's Social Security tax, the employer is charged with ratably withholding the amount of Social Security tax deferred from the employee's paychecks from January 1st of 2021 through April 30th, 2021. Now, while I don't know of many companies that participated in this option, if you did, be mindful of the impact to your otherwise normal cash flow from your paychecks in early 2021 as the amounts are repaid. IRS actually a couple months ago issued out some guidance to employers regarding how to account for this once the amounts have been repaid, and they will actually be charged with issuing a corrected W-2, W-2C, once the money is actually paid back to the employer. Another offering in 2020 by way of the Families First Coronavirus Response Act were tax credits associated with COVID-related qualified paid sick leave or qualified paid family leave. These are available for the employer. However, something we want to bring some attention to is that the legislation also provides a comparable credit for self-employed individuals carrying on a trade or business if the individual would be entitled to receive paid leave under FMLA if the individual were an employee of an employer. The refundable credits are claimed on the 2020 individual income tax return for that self-employed person. Of course, there are many more items related to the CARES Act, PPP, et cetera, and many relating to businesses. And these will be touched on in CRI's year-end planning webinar for businesses. So I hope many of you have also registered for that informative presentation as well. With that, Chris, I think we can move on to our next polling question.
Okay, thanks, David. Next polling question has to do with the stimulus payments that individuals received. The polling question is, payments made to individuals under the CARES Act, the 1,200 if single, 24 if joint, must be repaid if, is it if your 2018 tax return was used to compute the payment amount? Is it if your 2020 taxable income is greater than your 2019 return? Is it repayment of any excess amount is not expected, or is it none of the above? So give everyone a few moments to respond to that polling question. And in the meantime, David, we have a question that came in regarding HSAs. How does a person know if they're eligible to contribute to an HSA?
Sure, that is something where you have to, there are certain requirements that comprise what a high deductible health plan, like the definition of a high deductible health plan. And if your employer offers one of those plans, you are able to participate in an HSA, which in the HSA itself can be opened up either through your employer if they offer it, or most banks and financial institutions also allow for HSA accounts to be opened up and funded and maintained. Chris, do you have anything else to, any other details to add to that?
No, yeah, I think that summarizes it well. You just really, one of the main criteria is that high deductible health plan that you mentioned. So if you have any questions, you should look at your health plan and see if that's a qualifying high deductible health plan. So with that, let's look at the poll results real quickly. Payments, 51% of the audience say that repayments of any calculated excess amount is not expected. 41% say none of the above. 70% or 7% say it's part of your 2020 versus 2019. Looks like there may be some confusion out there, David. Can you clarify for folks?
Sure, I'd be glad to. So the amounts that you potentially received earlier in the year for the actual distributions that came out with when the CARES Act first passed, the receipt of them, they're not taxable, but instead they are an advance payment of a credit that will be computed. If you actually should get more, then you will get that credit and it won't be taxable. If you actually should have gotten less, there is no repayment of that excess amount.
Okay, thanks, David. With that, we will proceed to our next section on itemized deductions. And for this one, we'll pass it off to Jennifer.
Thank you, Chris. Good morning. As David mentioned, with the increased standard deduction having almost doubled, fewer people are taking the itemized deductions. However, this does lend itself to a little bit of planning opportunities. An old concept that is more prevalent now is the idea of bunching your itemized deductions, where you would bunch in one year to be able to itemize and then take the standard deduction the next year. So we'll kind of have that concept go through the next couple of slides. For medical expenses, not only do you need to itemize in full, you also have a floor for which you have to exceed before your first dollar of medical expenses is deductible. For 2020, that floor is 7.5%. That will increase to 10% for 2021. Mileage deduction can increase your medical expenses and help you get over that floor. For 2020, that number is 17 cents per mile for medical mileage. And a planning opportunity here would be to think through any kind of non-urgent medical procedures, such as braces and that kind of thing, and plan them for the same year as other medical procedures or for a year of which you have lower income, able to get you past that floor and potentially itemize.
Hey, Jennifer, can I
Yes.
stop you
Yeah, it looks like,
real quick? It looks like we're frozen up. So let me switch and try and reload the slides. Let's see if that.
There we go.
Let's make sure. Get back caught up to where. There we go. Sorry about that, folks.
Oh, no problem. Great. So as I said, for medical expenses, you've got to get over that floor. The first dollar over the 7.5 floor for 2020 will go towards getting you able to itemize for that tax year. Moving on to taxes, mortgage interest, and miscellaneous deductions, there's not really anything new for 2020 in these areas. However, there were some changes previously I wanted to remind everyone of that go through the year 2025. One of the most substantial is the limitation of tax deduction, and that is for your property taxes, your state and local income taxes, and any general sales tax that you're able to deduct. Those combined cannot exceed $10,000 towards your itemized deductions. For those in a large state income tax state, there's not a whole lot of planning you can do for that. But if you're in a no income tax state, or if you've retired, there may be an opportunity there to bunch, for example, property taxes into the same year to get as close to that $10,000 limit as you can in order to itemize in that year and switch to the standard and have that alternating effect. Mortgage interest on acquisition indebtedness, any debt that was incurred after December 15th, 2017 is limited. You can have primary home, vacation home, but the principal balance of that debt's limited to $750,000 or less to get the full mortgage interest deduction. If your principal balances exceed that, you will have to allocate that related interest to get the amount attributable to the $750 to be able to deduct that as an itemized deduction. Home equity interest is no longer deductible unless the proceeds are used to improve the property that secured it, either an expansion or a renovation of that particular property. And then those itemized deductions that we typically call miscellaneous deductions subject to a 2% floor, they are suspended through the tax year 2025 and no longer deductible. Moving on to charitable contributions, I did want to spend a minute on these. In general, charitable contributions are subject to several different caps based on your adjusted gross income. And those caps are related to what type of property you contribute and to what type of organization it's contributed to. In general, the most common limitations are capital gain property, being appreciated stock or real estate. That is limited to 30% of your adjusted gross income in any given year. Non-cash contributions such as miscellaneous clothing items to Goodwill. There's a special rule for conservation easements in this category. Those are limited to 50% of your adjusted gross income. Cash contributions increased to 60% recently for last year. That was donor advised funds, private foundations, supporting organizations, and public charities. However, with the CARES Act, that cash that you give to a public 501c3 charity alone is able to offset your adjusted gross income completely up to 100%. That will go back down to 60% for the 2021 year. But this year, if you've got it and you want to negate 100% of your adjusted gross income with cash to public charities, you can do so. Now, any of the contributions that you give that exceed these limits are available for a 5-year carry forward. So as far as that charitable planning is concerned, you've got those those limits to think about, but you could consider the bunching concept. If you've got some commitments to charities and you can make one for the year in January and then the next year in the same December, that may be a reason why to do that so that you can itemize one year and take the standard deduction next. There's also donor advised funds, and these are good tax planning, especially if you've got a year of substantial income that's not typical and you want to reduce that with a charitable deduction, but you're not sure, what entity if you want to contribute it to and kind of what amount you want to allocate against various charities. A donor advised fund will allow you to put a substantial amount of money into a fund. It's with an investment account, brokerage account. You no longer have access, rights to that money. However, you can donate now, take the deduction now, but direct what 501c3 public charities you want to go to in later years. So get the deduction now, have the donor advised fund allocate that money and distribute that money in future years without a tax advantage in those future years, but you do get it now. So that's a good charitable planning idea in a year of a lot of income. Also available are qualified charitable donations direct from an individual retirement account. Now, I'll talk a little bit later in the fact that required minimum distributions from retirement plans, that has changed to age 72. However, the age requirement to be able to do this qualified charitable donation directly from an IRA, it remains at 70 and a half. So you are able to contribute up to $100,000 to a public charity. This does not, you can't do a donor advised fund with this qualified charitable donation, but you can directly contribute from your IRA to a qualified charity up to $100,000 a year. It can satisfy your required minimum distribution requirement if you have one, and it reduces taxable income. It actually, reasons to reduce taxable income, and it will be addressed in the business seminar later, but that qualified business income deduction that some of you that have businesses through pass-through entities or self-employed, it could substantially reduce taxable income for that effect. And then also you can gift appreciated stock. This has been around for a long time with capital gains rates being from 0, but up to 23.8% with that net investment income tax surcharge that David will get to later. You could gift appreciated stock, take a deduction for the full fair market value of that stock as a charitable donation and not have to pay any tax on the appreciated value. So that's always a good charitable planning technique as well. And Chris, I think we're to the first polling question.
Okay, thanks, Jennifer. This polling question has to do with the charitable donation changes that Jennifer just mentioned. Which charitable donations in 2020 are deductible up to 100% of adjusted gross income? Are they cash contributions to donor advised funds, cash contributions to private foundations, cash contributions to public charities, or is it all the above? Give everyone a few moments to respond to that polling question. In the meantime, we've got a couple questions, actually quite a few questions that have come in. Jennifer, first one on the medical deduction under itemized deductions. You mentioned people can deduct up to 7.5% or up to expenses over 7.5%, and the question came in 7.5% of what number?
That is 7.5% of your adjusted gross income. So that would be the income prior to the standard deduction or itemized deductions.
Great. And another related question came in. Do health insurance premiums qualify as a medical expense?
Health insurance premiums would qualify if they are not, if you're having them taken from your employer plan on a pre-tax basis, they're not going to let you then go ahead and also take that as a deduction for medical expenses. Also, if you're self-employed, you would want to look towards having a self-employed health insurance deduction that is a deduction for AGI first before lumping those premiums into a medical expense category. However, if potentially, if none of those apply, you're not in a cafeteria medical plan with your job, you're not self-employed and possibly paying Medicare supplemental premiums, that kind of thing, Medicare premiums themselves, those are eligible for medical expenses and would increase the amount that you could get over that floor with.
Okay, great. Thanks, Jennifer.
You're welcome.
We'll go to the polling results now. Looks like quite a few people are on board. 60% of the audience says the cash contributions to public charities are deductible up to 100% of AGI. 31% said all the above. 9% said just the donor advised funds. I think that was the answer we were looking for, the cash contributions to public charities. Is that right, Jennifer?
That's correct. It's just to those public charities available for that 100% limitation.
Okay, great. I'll hand it back off to you, Jennifer, to cover retirement accounts.
Great. All right, for retirement contributions, planning for that, we always recommend if you've got the funds and you're not going to need them prior to retirement age, that you maximize your contributions to employer sponsor plans, any IRAs, or simplified employee pension plans that are great for self-employed individuals. Another reason why is to reduce that taxable income figure, may reduce the amount of Social Security income that's taxable to you, could reduce that premium surcharge on Medicare premiums, just great to get that taxable income down. Something that has become more prevalent after, I feel like, has kind of fizzled out after the first few years is Roth conversions. As a reminder, a Roth IRA is post-tax money. You contribute post-tax money to an IRA account, but any growth within that account, any appreciation within that account is also tax-free when you take those distributions out. So something to consider if you've got some asset values that are reduced right now. I know a lot of people's accounts may be reduced right now, but if you see future appreciation likely and feel that your future tax rates in retirement may be the same or higher than they are now, it's a potential to convert that money and have that future gain not be taxable. There's no 10% penalty on conversions as long as you pay the tax out of non-retirement funds, because you will pay tax on the current asset value of that conversion. But another good factor with that is that during the owner's life, there's not any required minimum distributions. So if you feel like that IRA is something that you're going to pass to your heirs and you want to maintain that value and not have to take any distributions out of it, this would be something to consider. Do ask that you talk to your tax advisor, because once you do it, there's generally no recharacterizations allowed to take it back to a traditional IRA. I do have charts for your convenience here with the contribution limits. For employer plans, it's 19.5 cap for 2020 on your deferral, as opposed to 19,000 in 2019. And then the catch up if you're 50 or older is 6,500 as opposed to 6,000. Contributions for IRA limits have not changed. It's $6,000 per individual and $1,000 catch-up. One thing that has changed, though, is historically, once you reach age 70 and a half, you are unable to continue making IRA contributions. And with a nod to the workforce, people staying in the workforce longer, they have repealed that maximum age limit. So if you're 70 and a half or older, as long as you're otherwise eligible and have earned income, you can continue to make IRA contributions. There has been several changes to retirement distributions as part of the Secure Act this year. The age of your required minimum distributions, as mentioned earlier, has increased from that 70 and a half to 72. That is for those that had not begun their required minimum distributions as of January 1st, 2020. So if you had already started those distributions at 70 and a half, you're going to have to continue those. But for people that had not met that required beginning date as of January 1st, 2020, you do have until age 72 to take those distributions. Now for 2020 as a whole, you do not have an RMD requirement. That was eliminated as part of the COVID relief to not have to take that required minimum distribution for 2020 if you do not want to. And that's not something you have to make up in 2021. It's just an elimination of this year, and your required distributions come back on 2021. Now, for both qualified plans and IRAs, you can now take penalty-free withdrawals up to $5,000 in the case of a birth or adoption. I do want to put a caveat there that, for qualified plans, the plan documents are going to need to be updated. So it may not be something you could go do tomorrow. You'd want to check with your plan, but something to think about if you are going to have a birth or adoption in the future and would like to take that benefit of penalty-free withdrawal. Also, a large change in the IRA world. Historically, for non-spouse beneficiaries, there was generally an option to do a stretch provision, so take distributions of that inherited IRA over your, the beneficiary's life expectancy table. That has changed and has been replaced by a 10-year distribution cap. They want all of that inherited IRA's balance out by the 10th calendar year following the year of death. So there are some exceptions for minor children, disabled individuals, and beneficiaries that are no more than 10 years younger than the original holder of that IRA. But essentially, they are looking at a 10-year payout after death on inherited IRAs. As David mentioned earlier, there is a retirement distribution specifically related to COVID. It is up to $100,000 from eligible plans through the end of this year. And by qualified individual, it is someone that is tested positive, either the owner, spouse, or dependent of the account, had adverse financial consequences as a result of quarantine, reduced hours, or job loss, unable to work due to lack of child care through COVID, or if you're a self-employed individual, a adverse financial consequence as a result of reduced hours or business closure. Now, this $100,000 eligible distribution has no 10% early distribution penalty. And as usual, it is going to be taxed at ordinary income tax rates, but is going to be ratably applied over a 3-year period. So instead of paying full tax, on the full amount in the year that you receive that distribution, you're going to split it up over 3 years. You do have the option to go ahead and tax it all in the current year. That may be something you look at if you know that your income is going to be, your tax bracket's going to be higher in 2021 or 2022. You do have the option to tax it in the year distribution. One thing, I kind of think about in this retirement distribution is we do have a lot of individuals with adverse financial consequences. Maybe they're working down their savings accounts and they haven't wanted to touch that retirement plan because that's what we're all drilled into thinking, don't touch retirement, don't touch retirement. If you think you may have to in 2021, you might want to consider taking it in 2020 because you have the ability to repay it. So if you take it in 2020 and you don't end up needing it, no harm done. If you wait till 2021, you are going to be subjected to the 10% early penalty, and you are going to have to pay tax immediately on the full balance in the current year of distribution. As far as repaying it, you have the ability to repay all or part of the distribution within 3 years. And if you've already paid tax on those funds, you can recoup those taxes by filing amended tax returns. So if you can repay all, it's going to look like a rollover contribution, part of the distribution, get that money back that you've paid. So all you would really be out is the lost earnings on that account. Something to think about. And now we are at our next polling question.
Thanks, Jennifer. This next polling question covers that retirement age for taking R&Ds. So starting in 2020, the age at which an individual must start the required minimum distributions from their retirement plan. Is it age 70 and a half? Is it age 72? Is it age 72 and a half? Or is it age 75? Give everyone a few moments to respond to that. In the meantime, try and tackle some of these questions that have come in. Jennifer, you mentioned there is an additional catch-up contribution amount for people over a certain age. Can you explain a little bit further what a catch-up is for those folks?
Sure. To encourage people to go ahead and contribute to those plans throughout their lifetime, they do allow, and above the regular contribution, a additional catch-up contribution. For IRAs, it's $1,000, and that is for individuals that are age 50 or older. So they can go ahead, they're nearing retirement closer, say, than a 25-year-old, so they can put in a little bit extra, and we call that a catch-up contribution.
Great, thanks. One more question that came in, the new rule on inherited IRAs having the 10-year stretch. Yes. Is there any grandfathering in of already existing IRAs, or for people that are already taking distributions from inherited IRAs, or does that apply to all IRAs?
I believe this applies to those that have not, It would not change the distribution rules of one that's already transferred. This would be for newly inherited IRAs. Is that your understanding, Chris?
It is, yeah. It's for newly inherited IRAs going forward, not existing IRA distributions that people are already taking. And I don't believe there's a grandfathering in terms of the IRAs itself.
Right.
I mean, if you already have an IRA and someone passes, you can inherit that IRA and not do the 10-year stretch.
That's right. And there are some that have incorporated IRAs within their estate planning and the use of some trust that may very well need to go back to their tax advisor with this new rule and rethink if you've got some trust involved with your estate planning, because I don't believe there is a grandfather provision unless it's already been inherited. Like Chris said, that there may be some changes to your estate planning depending on how you've got it set up. The only exceptions I know of are the ones that I mentioned with the minor children. And I do believe once that minor child that's inherited the IRA turns 18, I think that's when the 10-year cap would start for them. Disabled or chronically ill individuals, and then individuals that are not more than 10 years younger than the original owner are the only exceptions I'm aware of.
Thanks. Well, look at the poll results real quickly. 73% of the audience say that the new age for receiving mandatory RMDs is 72. 13% said 70.5. 12% said 72.5. So I think the audience is on board there with the new higher age for RMDs. With that, I am now going to pass it back to David, who will cover capital gains and losses as well as 1031 exchanges.
Thanks, Chris. Okay, so on our next slide, we have the 2020 long-term capital gains rates that we know about. As Jennifer mentioned earlier, you can see here there is a 0% rate. So 0 is the lowest and 20 is the highest, with the potential of adding an additional 3.8% from the net investment income tax. That tax is an addition to the long-term capital gain rate, effectively. If your modified adjusted gross income exceeds $200,000 for single filers and $250,000 for married filing jointly, and it's the amount to the extent that it exceeds those thresholds, that your net investment income exceeds those thresholds, is what is subject to the 3.8%. So you can effectively think of it as 0 is the lowest and 23.8 is the highest, depending on where your income falls and if you have net investment income. Again, to clarify, that net investment income also includes all of your investment income. So it's not just long-term capital gains, it's interest income, dividend income, things like that. Okay, on this slide, there are a few things we want to point out. The first is the distinction between realized gains and losses versus unrealized. Really, how you can think of that is until you actually finalize a transaction, sell a stock or sell a capital asset, you haven't actually realized that that event. There is no actual taxable event until you actually finalize that transaction. So even though you buy a capital asset or a stock at a certain price, and it may go up or down during the year, if you had it in 2020, it did both, and nothing is realized until you actually sell that particular asset. And if you held it for longer than a year, then it's long-term, and then it falls into kind of the categories that the rates that were on that prior slide. So it actually, when it comes to these year-end planning discussions, it's not uncommon for us to have conversations with clients about capital losses and capital gains that already happened, but the year's already over and done with, and so there's really not much we can do that affects that prior tax year. In this case, with 2020 still having some time left, you can take some of these items to consider. You can work with your financial planner and your tax advisor and come up with a good strategy to kind of round out the end of the year. Some of what we're talking about now, or all of what we're talking about now, is based on the current guidance, which is somewhat unclear in terms of the future. We don't know, as Jennifer mentioned earlier, we don't quite know exactly, or will mention in the later discussion, we don't know exactly what the future is going to hold. So right now we're working with the capital gain rates that we know about right now. Again, to bring note to it, there is a 0% bracket. So one could potentially, if you have under $80,000 if filing jointly or under $40,000 if filing single, if you have capital gain income that comprises all of your income below those amounts, then you actually would have your income not taxed if it is long-term capital gains. Again, with some of this year-end uncertainty in the stock market, it may result in paper losses or it may result in paper gains. So that's going to be something that we're going to want to consider as we move into the next couple slides and discussion points. So you might want to think about whether you actually sell certain positions to offset capital gains. If you actually have some realized long-term capital gains, you could generate some realized long-term capital losses. Or alternatively, you could actually, if you have some realized long-term capital losses, you could fold in some realized and intentionally realize and accelerate the realization of some long-term capital gains. Just a quick pause point. This is where we as CPAs and tax advisors really enjoy working with as part of a team with your financial advisor or level 4 advisors with it, which is a division of CRI, to develop an approach and game plan to maintain a sound financial position while also minimizing taxes. On this slide, you can see some points related to capital gains and losses. Overall, if you have a net capital loss, so it could just be one capital loss that you incurred, or it could be a lot of your transactions all combined together to arrive at a net capital loss. The maximum net capital loss that you can deduct per year to offset ordinary income is only $3,000. The excess is not lost, the excess can be carried forward, but that $3,000 hasn't changed in a long time, and we haven't heard of anything that is going to increase it in the future. And so even if you have a $50,000 capital loss in the current year, the only quote benefit that you get in the current year is you can deduct $3,000 of it if that's your net capital loss. So this is why we're having a discussion on some ways to consider accelerating that benefit. You do, however, want to be mindful when it comes to generating or incurring capital losses. You want to be mindful of the wash sale rule that effectively prevents you from having your tax loss cake and eating it too. You can't both sell a transaction, generate a loss to offset capital gains, and then immediately reinvest back into that position to kind of be right where you were before the transaction. That's not allowed. That's what's considered the wash sale rule. So you want to be mindful of that. And if you do have significant realized losses, consider a sale of appreciated assets to, again, accelerate that benefit of the tax loss versus having it being carried forward for potentially many, many, many years. On the other hand, if you have significant capital gains, consider reinvesting some or all of these gains into what is also unique to this year, most recent tax law change, a qualified opportunity zone fund. Also, if you have significant gains or potentially are going to have significant appreciated property, you can think back to what Jennifer mentioned when it comes to the donation of appreciated property to a public charity. If you were otherwise planning on giving anyway and you have appreciated assets, you could both satisfy that giving objective and giving to a charity while also avoiding capital gains on that appreciated property if you donate that appreciated property to a charity. And something that I like to bring up, especially in contrast to the next slide, which is on like-kind exchanges, if you sell your home, your actual personal residence, so long as you meet certain tests, the first one really being having lived in that house as a primary residence for 2 years within the past 5, you can exclude up to $500,000 of gain if you file married filing jointly, and $250,000 of gain if you file as a single taxpayer. And something we also just want to bring some attention to as it relates to those of you that have investment properties, investment assets, and real property. A 1031 like-kind exchange is a really popular way for real estate investors to defer capital gains, basically by selling one at a gain and then rolling that gain into a similar or like property and deferring the actual tax recognition of that gain. We want to bring some attention to this because there have been some efforts to potentially change the potential for those to participate in like-kind exchanges. And beginning in 2018, these are limited to just real property. There's some allowances for incidental personal property, but it's just real property. Now, there are a lot of rules to comply with, a 45-day rule, a 180-day rule when it comes to identifying and actually closing the transaction. So because of all these rules and requirements that you have to comply with, we do recommend that you consider the use of a qualified intermediary whose sole job is to help you stay in that lane and kind of navigate down the path of a 1031 exchange that complies properly. Again, there have been some prior efforts and noise to potentially either fully undo or limit the ability to participate in these like-kind exchanges. So we at CRI are going to constantly be monitoring that legislation and to factor that into how we advise people going forward. Chris, with that, I think we have our next polling question.
Okay, thanks, David. Next polling question has to do with those capital gains rates. The lowest long-term capital gain tax rate is it 15%, 20%, 0%, or your marginal income tax rate? With that, try and tackle a few more of these questions. They're rolling in pretty quick now. David, you mentioned one of the options people should consider are qualified opportunity zones. Can you give folks the 30-second elevator speech on what a qualified opportunity zone is?
Sure, Chris. Qualified opportunity zones were areas of the country that were determined to be I guess areas for and designations for where reinvestment can be invested, where reinvestments can be invested in different communities. And the 30-second version of it is a program that was created by the TCJA, Tax Cuts and Jobs Act, that allows for investments in those types of communities and areas to ultimately have potential long-term tax advantages for those that invest in and potentially roll in capital gains into those investments. So it's a recent opportunity, no pun intended, to defer capital gains into the future or potentially avoid them.
Thanks, David. Appreciate that. Also encourage those that have an interest in qualified opportunity zones. That CRI does have a lot of resources on our website, cricpa.com. We've had webinars on opportunity zones and have resources on our website. So those wanting more information, please feel free to go to our website and learn more about it. Let's go ahead and look at the poll results now. Looks like we've got 81% of the audience saying 0% is the lowest long-term cap gain rate. So it looks like everyone was paying attention, David. So good job there. With that, we will pass it off now to Jennifer, who will cover other considerations that you may need to be thinking about as 2020 wraps up.
Thank you, Chris. I'm just going to touch briefly. I wanted to bring up the subject of net operating losses. While I'm sure it's gone into detail in the business session, for those of you that are self-employed and potentially have some losses from 2018, 2019, and going forward into 2020, the Tax Cut and Jobs Act did eliminate the ability to carry back those losses. But the CARES Act has changed that, and for those 2018 and 2019 losses, and then again in 2020, you are able to carry those back to each of the 5 preceding years. Did want to point that out, especially because that is the default. So if you do not want to go through the carryback process, which would get you potentially cash in hand now, but if you don't want to go through that process, you do have to elect out of that carryback period, and those elections for 2018 and 2019 losses would be made as statements on your 2020 individual tax return. So some opportunity there to carry those back and to get some cash back or some credits. So I wanted to point that out, but also there's an affirmative need if you do not want to carry it back that you'll need to do with your 2020 return. Going on to tax-exempt giving, just wanted to reiterate that the annual exclusion, which is the amount that you can give up to any individual without hitting that exemption amount and filing a gift tax return, is $15,000. It is $30,000 should you choose to gift split with your spouse. You can also give unlimited direct payments of tuition or medical payments, and that would not reduce your lifetime exemption. So you can gift up to $15,000 a year. You can make unlimited payments of tuition and medical if it's direct to the facility, and then you have that $11,580 lifetime exemption that's increased for inflation. Now that doubled a couple years ago, so the IRS has stated that should that lifetime exemption be reduced in the future, it would not claw back and go to gifts that exceeded the amount. So say in the future it goes back down to 5 million or 3.5 million, the IRS is not going to come back and tax gifts that are in excess of those numbers as long as they were given during the time that the exemption was increased. So looking towards your estate planning and what you have, you may want to consider making some gifts earlier rather than later. Talk to your tax advisor. As far as an update, can't do that without at least touching on the presidential election. So what do we know now? Honestly, we know what the law is exactly now. Thoughts on what do we expect with the projected president being Joe Biden? You know, he's had several tax plans, some extreme tax plans as far as the estate tax world and some tax rates for the wealthy individuals. My thoughts, and maybe not the thoughts of everybody in CRI, but the Senate, you know, we probably won't know until early January with Georgia, but if the Republicans hold the Senate, you know, the House is Democratic majority, but that margin did shrink. I don't know that we're looking at extreme changes, at least for the first 2 years until the Senate seats are up for re-election. So just kind of putting that out there. We don't know, but if you're interested in looking at what the different various tax plans are, we do have available on our website at cricpa.com at the bottom of that slide a comparison of what the current tax law is in many various areas, both corporate and individual and estate, and a comparison with what you know, the two candidates were stating during the election process as what their plans were for taxes. So interesting chart to go and check out. And I think we're ready for our next poll question.
Okay. Thanks, Jennifer. Next polling question has to do with gifting. Which is not a gift eligible for the annual exclusion? Is it a direct payment of tuition of $50,000? Is it direct payments of medical expenses of $25,000? Is it a cash gift of $10,000? Or is it a gift of property with a fair market value of $40,000? So give everyone a few moments to respond to our last polling question here. And I know we're running short on time. Try and handle a few more questions that have come in, and then we will wrap up here. Jennifer, question that came in, does the unlimited lifetime gifting amount, the 11 million number that you mentioned, does that include gifts to a spouse?
No, there is a unlimited spousal gifting spousal, so it would just be non-spouse items or beneficiaries. Okay.
And one more, which may give everyone a hint on this polling question, but someone asked if you could elaborate on the unlimited option for paying tuition for gift tax purposes. Can you elaborate a little bit further on that?
Right. As long as you make a payment directly to the institution and it does not go through the student's hands first, you do not have to reduce your lifetime exemption for that amount. It's an unlimited payment as long as it's made directly to that educational institution.
Okay, thanks. We'll look at the poll results now. 72% of the audience are on board, saying the item not eligible for a gift tax annual exclusion is a gift of property with a fair market value of $40,000. We then had the rest of the audience pretty well split between the other three options, but I believe that that last option was the answer we were looking for, right, Jennifer?
That's correct. Anything with property and a $40,000 fair market value would exceed, even with gift splitting, the annual exclusion.
Yeah, thanks, Jennifer. And now I know we are pushing top of the hour. So with that, I want to go through. We've been getting lots and lots of questions that are coming in. Fortunately, we can't get to them all during this hour. So I would encourage you to reach out to your CRI advisor. They can definitely help answer your questions. Also encourage you to connect with us on social media, CRI CPAs on all our major platforms for social media. It's a great opportunity to stay connected with us, also get our news alerts and feedback that we have, insights that we have. You can also text CRI to 66866 so that you can get those automatically. And with that, I'd like to also thank our presenters today, David White and Jennifer Jenkins. Both did an excellent job going through a lot of material. And can't cover everything, but I think they've done an excellent job of giving everyone things to think about as the year winds down. And lastly, I want to thank you, our audience, for attending today's webinar on year-end tax planning for individuals. Appreciate you taking an hour out of your day to be here with us, and hope you can return for future webinars. Thank you.